Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast-track your financial goals. Here's your host, Kavita Baratake.
Welcome to Moneywise Learning. This is financial education for ages 10 and up. I'm Kavita Baratake, founder of a company called Cherry Street Investments. And I've been doing this Moneywise Learning courses since 2017, I believe. When my daughter was in middle school, I started teaching it as an after-school course. Then I went online with it during COVID. So did a webinar series called Moneywise Learning. This somewhat similar to this, but every time I refine something and add more things. So today's session is on retirement, what you need to know about retirement and how to become a millionaire and hopefully a billionaire. Our team is me, Kavita, as well as Ritesh. Ritesh is my assistant. Again, for all things related to joining these webinars, please reach out to Ritesh, ritesh.barke@gmail.com. A few quick housekeeping rules. Please ask all the questions in the Q&A box, which come up. As they come up, even though I'll get to the questions at the end of the discussion, please type your questions as soon as you remember them or it comes up, because you might forget them if you wait till the end of the discussion. The recordings will be sent out within 48 hours to the email addresses of both parents as well as students. All recordings are posted on youtube.com/@CherryStreet. So please go here and subscribe to this YouTube channel so you can be auto-notified of uploads as well as future videos that we might put together. I'm always posting videos on different topics here related to finances and investment in real estate and others. So if you're interested in learning how to invest, you should follow the channel. So let's look at Moneywise curriculum and what we've covered so far. We have been through 6 sessions so far. We've talked about assets and liabilities. We talked about loans and interest on money. We talked about insurance. We talked about bank accounts. We talked about taxes, what kinds of taxes there are. And last week, we talked about credit scores as well, understanding how to build your credit history and score, and also understanding what goes into calculating a credit score. So week 5, this is week 5, and we're going to talk about 2 topics this week. One will be why worry about retirement. And also the second topic this week will be when you get your first paycheck, what is it that you can expect from the paycheck? What are the different components of a paycheck, right? So just so when you start working, you're aware of what goes into a paycheck. The last week of this Moneywise series will be on monthly budgeting, as well as investing, stocks, bonds, mutual funds, real estate. We'll be covering different kinds of investments that you can make. You don't have to be an adult to invest. You can use accounts right now. You can invest in stocks and other things as well, in real estate as well. So going back to last week's assignment, I asked people to get access to a free credit report for yourself if you're over 18, or ask a parent for their credit report. I asked you guys to review different sections of the credit report with your parent and look at what each section covers, how are scores calculated, what kind of debt do they carry, is it good debt or bad debt, and discuss with your parents how they're going to help you build your credit. Can they add you to a social security card or to the credit card? Are they reporting your credit scores against your social security number? Do you have a social security number? I hope all of you do have a social security number, which you should. And if you're over 18, can you potentially buy a car and open a car loan? So let's see what kind of lessons we learned from last week's assignment. People want to type it in the chat box. If you also went and played the cash flow game, I'd like to hear from you and tell me what you think about the game. So please type your comments in the chat box. Let me know what were some of the lessons you learned. Parents' credit score is 790. Okay, what else? That's a good score. Is that a good score or is it an excellent score? Anybody? Don't keep changing your credit card, okay? Which means don't keep closing and opening new ones, or what do you not want to do? Sorry. Pay in full. Good job, Gianna. Don't get bad debt. What's bad debt? Anybody? What is bad debt? Ishan says cash flow game was really helpful. What did you learn from a cash flow game? Riley says, my parents have a credit score of 800. Good job. Rohan, credit score 800. Good job. They're all doing really good. You should say high five, give a kudos to your parents. They're doing a good job with their credit. Loans that are liabilities. So basically, loans that are liabilities is bad debt, right? Loans that don't make money for you is bad debt. So loans that are liabilities. What are liabilities? Liabilities take money from your pocket, right? Assets put money in your pocket. Shana said she played the cash flow game. It taught a lot of things like assets and liabilities, and it was a fun game. Did anybody else play the cash flow game? What do you think about it? Anything else from good debt in investments, properties, and deals? Good job. Anybody else looked at your credit score of your parents? What else was in the credit score besides the actual score? Anything which stood out to you? Anything you remember from the credit score that you thought you learned? Did you look at the different pieces of the credit score, like credit history? Was there a tracking of maybe the different addresses your parents lived? Did you guys actually look at it? Anybody looked at an actual report from a credit bureau? Did your parents actually show you a report? Okay. So this week, I want you to go back and ask them for a report. Okay. Credit scores are calculated by payment history, hard inquiries, and credit usage. Good job, Shana. If you didn't look at a credit report, I really want you guys to ask your parents to pull a credit report for you. It might not be your credit report, it might be theirs. That's okay. But I want you to really look at a credit report because it'll really help you understand those different components that we spoke about. Okay. With that, let's move on to today's lesson. I called it Why Worry About Retirement, but I also want to call it How to Become a Millionaire, because we're going to talk about how easy it is to make $1 million. So why would you want to think about retirement right now? You guys are just 11, 12, 15, really young, right? Why worry about retirement? You're not going to retire anytime soon, right? So here's what it is. It's all about time. You want to take advantage of the power of compounding. And the sooner you start, the more time you have on your side. So compounding is basically interest paid on interest. So think about it. I have $1,000. I earn, let's say, $100. Now, the next time I earn money on it, I have $1,100, not $1,000. So I make money on that $1,100. Next, I have $1,200. Now, you have $1,100, you make, let's say 10% on 1,100, it's $110, right? Now you're making money on $1,210 because you had 1,100 plus 110. So that's really the power of compounding, is that you get interest paid on interest, right? Besides the principal that you have. And it continues to snowball into something larger. When you have more time, you have more money when you have compounding, okay? So let's talk about who wants to be a millionaire, and we'll talk about, I hope you want to learn how, right? So 5 steps to becoming a millionaire. You want to start early and save regularly. Like I mentioned, the only reason we're talking to young kids, 11 to 18, about becoming a millionaire or saving money early or thinking about retirement right now is because you want to start early. You might even start right now. I opened a retirement account for my daughter when she was 15. So you don't have to be a certain age to open a retirement account, but you do have to have income to open a retirement account, right? So I employed my own daughter for my business. She does work for me and I pay her money. So she started her retirement account when she was 15. So you don't have to wait to become 20, 25, whatever it is to start a retirement account. So you want to start early and save regularly because time is your best friend. You want to be disciplined because if you pay yourself first before you pay your bills, you'll start saving. That's the secret to saving, is always remember to pay yourself first. So if you make $1,000 doing your first job somewhere, then pay yourself 25% of it at least, right? $250, pay yourself first. What does pay yourself mean? You go save it somewhere and put it somewhere else. Okay. So you want to be disciplined about savings. You also want to invest wisely. So it's not enough to just put it in a bank account, which makes 1%. Your money doesn't grow. You want to find ways and means to put it in different kinds of investments. And you also want to diversify. That's what we call diversification, is putting it in different investments, not everything in one. Because if that one thing goes down, you might lose all your money, right? So we diversify across investments and not put all our eggs in one basket. And we never get greedy when we're investing. Just because you're making good money somewhere, we don't go double up on that and put everything we have in that. That's what people did in crypto and other things, and they lost a lot of money, right? So greed is your enemy when you're investing. You want to be patient. You want to be wise. You want to stick to a plan. You make a plan and stick to it and invest. You always want to be patient. A lot of people will get into something when it's going really well, like crypto is like crazy high. Now I want to put in money in crypto. It doesn't make any sense. When things are not great, that's when you put in the money, and then you pull out. You wait patiently for it to go up, right? Or you take a calculated risk and say, okay, this makes sense, because you do research and figure out where to invest your money. Or you just go invest it in a fund, in an index fund. So you get all the stock market, all of the stock market. You might go buy your first house using your investment or your savings. So you always want to be patient when you're investing. So what that means to me is that you don't pull out the money when the market is down. You just stick out there and wait, because what goes down does come back up. So unless it's a case where someone is going bankrupt, you don't pull out money when you have a problem. Okay. Network is your net worth. What does that mean? When you find people who are smarter than you, that are already where you want to be, you want to make sure you're around them, because you're going to learn from them. Okay. So this is very important to be successful in your life, whether it's about money, whether it's about things you want to learn. Your network is always going to be equal to your net worth, right? If you have a good network, if you are the smartest person in the room, you're in the wrong room. That's what they say, and it's very true. So you want to be around people who are smarter than you, so you can learn from them. Okay. So if you are, let's say, in a room of millionaires, it's likely that you'll become a millionaire too. Or if you're in a room full of billionaires, it's likely you'll become a billionaire too. So let's talk about how to become a millionaire to start with, right? We'll talk about the billion later. So let's say you are very modestly saving $25 a day. Okay. You're working somewhere, you're saving $25 a day. You figure out a good investment which returns an average of 8% a year. And you are patient. You wait 30 years. You keep doing this 30 years methodically. I'm not saying you can invest more than 25, but this is kind of like a minimum baseline, and we'll see how much it becomes in 30 years. Okay. So we have an initial investment of $0. We have a monthly contribution of $750, which is $25 a day for 30 days. We have time of 30 years. We have an interest rate of 8% estimated. So when we compound it annually every year, we hit calculate button, and this is what we get. You're going to have $1,019 when you have compounding over 30 years. So this is the amount of money you put in, right? This is your total contribution in 30 years. This is the growth you have in 30 years. And you just saved $25 a day. That's it. So time is always your best friend when it comes to investments, and patience. So let's look at another way to look at compounding. If I put $50 a week, okay, for 10 years, and only assume a 5% interest on my money, then I have $33,000. But if I take the same 5% and look at 30 years, I have same $50 a week. And for 30 years, which is $200 a month, right? $50 a week for 4 weeks is $200 roughly a month. I have $176,000. But now let's say you're able to go to $1,000 a week, right? Or let's take a more realistic, right? $250 a week contribution, which is $1,000 a month. So in 40 years, you'll have 1.6 million. Now, this is really the power of compounding, is that the more time you have, the more money you can make. The less time you have, the less you can make. So let's say you start working when you're 20 something and you don't do any retirement account investing, you don't do any kind of investments, and you don't even think about investing or doing anything until you're 35 or 40, and you have only 20 years for retirement, let's assume. So there's only so much 20 years is going to buy you, right, in terms of growth. But 40 years will buy you a lot more. So that's why I want you guys to start thinking about that right now rather than later, because time will really help compound your dollars much more. And remember, 5% is very low. You can probably make about 8 or 10% on an average outside if you invest wisely. So this is very, very conservative investment at 5%. So today we're going to talk about retirement accounts and why we need retirement accounts, right? So retirement account is different from, let's say, money you put in a bank account. The reason is essentially you are using that money for retirement. Why would you put money away for retirement versus just put everything in your bank account? Because it gets you certain tax benefits when you put money away for retirement. That is one of the primary reasons. But there's also another reason. Your employer, if you're employed by someone else, might be giving you another benefit called matching, which means, let's say you contribute a certain amount toward retirement, they'll match that contribution in retirement account. So it will kind of double up on your retirement account. That's another good reason to put money into a retirement account. So the types of retirement account, very simply, these are very basic types. There are so many more out there that I haven't covered, but I think if you get a good understanding of these, it's good enough for now, right? We have 2 different kinds. It's called traditional and Roth. And we'll talk about the detailed differences between traditional and Roth. And just to tell you, there'll be a quiz at the end and there'll be Amazon gift cards. So if you guys listen in, there'll be a lot of questions about traditional versus Roth and also the different kinds of retirement accounts. So I want you to pay attention here. So traditional is one style of retirement account and Roth is another style of retirement account, right? And we'll talk about the traditional differences between traditional and Roth. But within traditional, we have IRA, 401k, 403b, solo 401k. So let's say I'm a business person. I'm self-employed. I employ myself and I employ some other people. I have a solo 401k for one of my businesses, which means I'm self-employed. I'm a solo provider and I have my own 401k, my own retirement account. You might be employed by Amazon, let's say. They'll have a 401k account and then you can start contributing into your 401k and they'll match it. They give a certain portion towards your 401k. If let's say you're working in a public school or you're working for a charity, you might have something called a 403b. An IRA is an individual retirement account. So essentially, if you're an individual and you want to open an IRA, you can. You don't need a contribution. You need to make some money, which means you have to have income. And if you have income, you can contribute towards your IRA. Okay. On the Roth side, they have all of these. And just hold on here, and I'll explain what the difference between traditional and Roth is. So we'll talk about 401k versus IRA first. So 401k is usually, the structure is set up by an employer, or you could be your own employer, in which case you're self-employed. It's called a solo 401k in that case. An IRA is basically just by an individual. So you can open your own IRA. You don't need to be employed by anybody, right? You can be an individual contractor. You can go work for, distributing paper, or work for DoorDash, and then they give you a 1099. It's called a 1099. They'll basically give you money for working on DoorDash. Now you'll take that money and you can put it in an IRA. You can open an IRA account, and you're contributing towards your retirement, right? So the differences between 401k and IRA is in a lot of different ways, but one of the big differences is the contribution limits, which means how much can you put into the account. So if you have a 401k, your that means you have an employer, right? And then the maximum contribution, if you have an employer, is $22,500 a year right now. If you have a parent, let's say over the age of 50, they can contribute $30,000 a year. If you're self-employed and you have a solo 401k, then your maximum contribution is $66,000 a year, which is pretty large compared to 22. It's almost 3 times as much. And if you're over the age of 50, you can contribute $73,500. The IRA on the other end has a very low contribution limit of $6,500. So obviously, this is just not cutting it if you want to put more money. But when you're younger, you might start here, right? I actually recommend something called a Roth IRA, which is even better. We'll talk about traditional and Roth. So this 401k can be both Roth and traditional. And then similarly, IRA can be both Roth IRA and traditional IRA, okay? The penalty free withdrawal means that when you are a certain age, you can remove money there. From there, you'll still pay taxes. So the one thing you have to understand about 401k and IRA is that you pay taxes at some point, but when you pay taxes are different based on the traditional and Roth versions, okay? So we'll talk about traditional Roth here in a second, but even if you remove money from a retirement account before the age of 59 and a half, there's an additional 10% penalty, okay? But in addition to that, you could pay taxes as well. So let's talk about that later, but let's get to, I actually want to do this one, traditional versus Roth version, okay? So in a traditional account, your contributions are pre-tax dollars. What does that mean? Let's say you're making money, $6,000 a month, gross, it's called gross income, okay? You pay contribution from that $6,000 without paying any taxes on that $6,000. So it is a pre-tax money. So it goes into your traditional account without paying taxes, okay? Now it grows without paying taxes, but it comes out paying taxes. In a traditional account, goes in without taxes, grows without taxes, comes out with taxes, okay? In a Roth, it goes in after paying taxes, post-tax dollars. So if you earn money, you pay tax, then you take the rest of the money left after paying taxes, put it in a Roth. But the catch in Roth is it grows without taxes, it comes out without taxes. So let me summarize this again. This is important to understand. Contributions pre-tax, post-tax, which means you paid taxes, you didn't pay taxes on this, you paid taxes on Roth, okay? The growth, tax deferred, which means you're not paying taxes while it's growing, but you're going to pay taxes later. when you are ready to remove money, you'll pay taxes. Here, it's tax-free because you already paid taxes. There's no taxes after that. And then here, they require something called an RMD, which means it's required minimum distributions. So after you turn 72, let's say you have $1 million in your traditional 401k. They require you to take money out of that account, like start taking money out after the age of 72. Why do they need that? Because you're going to pay taxes when you take the money out. Remember, you didn't pay taxes for, let's say you're 20 years old, you start saving in your bank account, saving in your traditional IRA or traditional 401k. Then you don't pay taxes, you put in money, it grows without taxes. But then you start taking money out. They force you to take money out after 72. It's called required minimum distribution. And then you have to pay taxes whenever you take the money out. Okay? And the taxes will be paid depending on your tax bracket when you are 72 years old or whenever you take it out, right? You can take it out after 59 and a half, but you still pay taxes when you take it out on the traditional. And then withdrawal after 59 and a half years, you can take it out without any penalties, but you pay taxes on the withdrawal. But when you take it out before 59 and a half, you pay the 10% penalty plus taxes. So it's only taxes after 59 and a half, 10% penalty plus taxes before 59 and a half. I hope that's clear. On the side of Roth, it's post-tax dollars. You already pay taxes. And then after that, everything's tax-free, tax-free, tax-free. There's no taxes, no RMDs, no required minimum distributions, no taxes. And it can be withdrawn early, no penalty for qualified expenses. And we'll talk about what qualified expenses are. I really love Roth IRA for young people like you, because you don't pay much taxes when you put it into these accounts. Because right now, if you're making $12,000 a year, you don't pay any taxes. So it's really post-tax, no tax dollars going into a Roth. It grows tax-free. It has 40, 50 years for you guys to grow because you're young, and it comes out tax-free. And it can also be withdrawn early. And if you're going to college, you can use it for college expenses. This is an amazing way to save for your college, but you do need to make an income somewhere to use or to open a Roth IRA. Now we'll go back to talking about the example of a retirement tax benefit account. So let's look at no retirement account versus a traditional retirement account, right? We have a gross income. Let's say you're making 60K a year. Most of you will be making more than that when you graduate. But let's take 60K a year, 5K a month, right? 60 divided by 12 is 5K a month. So retirement contribution, let's take no money towards retirement. So let's say my income, taxable income is 60 minus your standard deduction. We talked about taxes. There's something called standard deduction that you get to take for single filer. Then your taxable income comes down to 47,800. This is very simplistic calculations, and this minimum this standard deduction keeps changing year to year, so this might not be current. So let's take 47,800 as your taxable income, or what we call adjusted gross income, AGI. You'll hear the words AGI. So your taxes now, federal plus FICA, is 12%. You're on the 12% bracket, plus 7.65%. Okay. Again, this might be more than 12%, but let's take 12%. Okay. So we have a total tax of 97.92 on this income. So effective income now is 38,407. Tax benefit that you got is nothing. You didn't put anything towards retirement. Let's say we put money towards retirement of 6,000 a year. Okay, so now your taxable income reduces by 6,000 because remember, these are pre-tax dollars, which means it's removed from your income before you pay taxes, pre-tax. So now your effective income comes down to 41,800 but from 47,800. So it came down by 6,000. Now your taxes also come down, right? Because it's a income, your income is now lower. So effectively you pay 33,000 in taxes, right? Your effective income now, you pay your income now, I'm sorry, 41,800 minus 8213 is 33,586. Okay. You also saved 6,000 into your account, in your retirement account. So now your effective income is 39,586. Okay. Everybody get the math? So now your tax benefit from this is 39,000 minus 38,407, which is 1179. So you saved or got a benefit of 1179 just by contributing 6,000 a year. So imagine now that you are able to contribute 20,000 or 19,000 or whatever your maximum limit was, right? Your limit here is 22,500. If you are able to max out that limit, you would be able to deduct 22,000 from here and then basically save taxes on and reduce your taxable income by $22,000. So that's why you contribute to a retirement account, to save on taxes right now and to let that money grow tax-free for the next 50 years or 40 years or however long you want to wait to retire. And then you can withdraw and pay money taxes later, because you have this period of time where you exploit the power of compounding to grow your money faster. And we talked about traditional versus Roth. If there are any questions, we'll come back to it. This is a complicated topic, so I want to make sure I cover it again. So we talked about qualified penalty-free withdrawals in your Roth IRA. Remember here, qualified expenses. These are down payment for your first home. You can take money from your retirement account for your first home. Qualified education expenses. So if you're going to college, you can take money from your retirement account. Unreimbursed medical expenses. So if you have large medical expenses, you are allowed to make penalty-free withdrawals from your retirement account. So should you contribute to your 401k, employer 401k, a traditional employer 401k? Usually, I told you about matching. Your employer contributes or matches every percentage or 0.5 percentage for every dollar that you contribute, every percentage you contribute. So let's say, let me make this simple. You contribute 6%, your employer might contribute 6%. You contribute 6%, your employer might only contribute 3%. So they either contribute every percent, 1% for every percent you contribute, or they contribute 0.5% for every percent you contribute. So it'll be 3% for 6% or 6% for 6%. So you're essentially doubling up on what you're saving in your retirement account by contributing. So whenever you join an employer, you always ask them, one of the things you ask them is, what do they contribute towards your 401k? Do they match? How much do they match? Right? That's important. The other thing is tax rate. So do you want to retire poorer, or do you want to keep the same standard of living, right? So if you expect that your tax rate at retirement will be lower because your income will be lower, then it's a good idea to contribute. If you expect that you can grow your money wisely in a retirement account, should contribute. But let's say your employer doesn't match, you have no benefits, then it might not be a place to contribute, right? Not everybody, it's a good idea for everybody. So let's look at employer matching. So someone has a $40,000 salary, which is too low now. If there's a 100% match plan and you're contributing, let's say $1,200, then the employer will contribute $1,200. So essentially, you have $2,400 in your account. Okay. So employer contributes 50%. For every $1,200 contribution, they only contribute $600. Okay. So it depends how much they contribute. is either it could be 50, it could be 100, it could be somewhere in between. But you want to figure out whether they match your contribution as an employer. Should you contribute towards a Roth IRA? I'd say yes. If you qualify to have a Roth IRA as a teenager, let's say you start working for DoorDash, definitely open a Roth IRA and contribute towards it. Ask your parents if they can open one for you or help you open one. They can always, if they have a business, they can always pay you from their business. And I want to say you cannot gift money here. This is not true. They can only pay you money from a business. So if your parents have a business, highly recommend to figure out how you can get paid from their business. To maybe you can do some work for their business up to $6,500 a year. The reason you have to get paid is you can only contribute active income into an IRA. So if you have passive income, it cannot go into an IRA. It has to be active income. And you want to find safe investments that will compound and grow your money for a long term. Tax-free growth, like an Roth IRA, you never pay taxes again because you have paid taxes when it goes in. And up to $10,200 a year, you don't even pay taxes. So it basically goes in tax-free, gross tax-free, comes out tax-free as long as your income is low, right? Below $12,500. Tax-free withdrawal is even better, right? Roth has tax-free growth and tax-free withdrawal. So again, I want to kind of look at three buckets. One is taxed, tax deferred, and tax-free. There are three things you need to understand about how taxation happens. So taxed means you take post-tax dollars. So that means, let's say a stock market investment or a bank account. You make money, your employer, you pay taxes, then you take the money into a bank account, or then you invest the money in a stock market, right? So they are post-tax dollars. When it's taxed before it comes to you, it's called post-tax dollars. All the growth is taxed with post-tax dollars in a taxed account. So let's say you put it in the stock market, it's a taxed account. Let's say you put it in real estate, it's usually taxed, but there are ways to make it tax deferred. We'll talk about that in a second. No taxes on withdrawals, right? And then growth is taxed, and then you can use the money. So let's say I take a typical savings account. I put money into the savings account after paying taxes. And then every month that I make money in the savings account, the bank gives me a tax statement at the end of the year where I pay taxes every year. So when I take money out of the bank account, there's no taxes, okay? Let's talk about tax deferred. So you take pre-tax dollars, which means you don't pay taxes. This is like a traditional or a traditional 401k or IRA. Pre-tax dollars goes in. Growth is tax-free. So it continues to grow for years as long as you don't pull it out. Withdrawal is taxed at retirement. There's no such thing as a free lunch. So you will pay taxes when you pull it out at retirement. That's your traditional 401k. That's tax deferred. Then we have tax-free, where post-tax dollars, this is a Roth. A Roth is post-tax dollars. So you pay taxes just like before you put it into the account, but growth is tax-free. Withdrawal is also tax-free at retirement. And then withdrawal can also be due to qualified expenses from a Roth. So that's the summary here. What kind of account is a stock brokerage account? It will be a taxed account. Okay, a tax deferred account will be a traditional IRA or a 401k, and a tax-free account or a tax-free account, you could say, but you'll pay in a tax-free account, you're still paying post-tax dollars, but you have the growth and withdrawal being tax-free. So you're paying taxes ahead of time, okay? Now, coming back to how to be a millionaire, let's see how taxes can hurt the power of your compounding here. So let's start with, we're saving just $500 a month here, 8% again. We have 35 years in this case. And tax during contribution period, tax rate is 25%. Tax when you're withdrawing money is 25% also. So if you look at the power of compounding, your $500 a month for 35 years becomes around 1.2 something million. Okay, because you have this much in deposits over 35 years, but look at the growth. This is what you want, the exponential growth of compounding. It's always this kind of a curve because you're getting interest on top of interest. Interest starts earning interest, and that's the compounding effect. So let's see why taxes are not your friends. So you have taxable account. So let's say you were saving the same money that we talked about, which is $500 a month for 35 years. In a taxable account, you'll only have $751,000 because you pay taxes. In a tax deferred account, because you didn't pay taxes ahead of time on that 500 and you allowed that money to grow, it has a little bit more money, 904. But let's say you had the option of not paying taxes. That's where your money would grow, $1.2 million. Okay. You don't pay taxes when you pull it out. That's where your money is really growing the most. So taxes will really erode your growth or reduce your growth from like your 1.2 million to 751,000 just with 25%. Now, let's say someone was in a 50% tax bracket. They would lose so much more in taxes because it's taking away money which can grow for you and make money for you. Okay, a lot of questions. I know it's a tough topic, but Gianna asked, what's the difference between a retirement account and a bank account? As I mentioned, a retirement account is more of a taxed account, and a bank account is more of a taxed account, and a retirement account is more of a tax deferred or a account where you don't have to pay taxes during that growth of the account. Depends on whether it's a Roth or a traditional. IRA stands for individual retirement account. So is there contribution limits on these accounts? I think we answered that question. Which is better, Roth or traditional? Roth generally tends to be better, but not everybody qualifies to put money away in a Roth. There are income limits for a Roth IRA, which is the problem. Not everybody can put money and get tax benefits from a Roth. Why is it called pre-tax if you pay when you take it out? And why is it post-tax when you pay tax when you put it in? Okay, let's answer that a little bit. So pre-tax means, let's go back here. Let's look at Roth versus traditional. Pre-tax means that money went in without paying taxes. So it's pre-tax dollars. Money goes in after paying taxes. That is post-tax dollars. Okay. The only difference is there is no such thing as a free lunch. You'll pay taxes somewhere. Right? Here, money goes in without paying taxes. Money grows without paying taxes, but money comes out paying taxes. Here, money goes in after paying taxes. Money grows without paying taxes. There are no taxes at all at distribution. So sometimes it was almost better to do this if you can save money later. I mean, you'll save a lot of money. Let's say I put in $1,000, but it's in a Roth. That $1,000, let's say, becomes, I don't know, $100,000. Now you made $99,000 and you don't have to pay taxes on it. That's a great situation because just with 1,000, you make 100,000. If you're expecting your money to grow a lot, a Roth is a great place to park, but you can't always use a Roth. They have conditions. When you're young and you make less money, then you can do a Roth, but not everybody can put money in a Roth. If you take money out of your 401k at 60 years of age, do you still have to take more money out at 72? So you can take money out at 60, but you don't, then 72 doesn't really apply. There is a certain amount of minimum distributions that you have to take. So if you take it out early, then you don't have to worry about doing it later necessarily. How old do you have to be to gain active income? I think you can get a job when you're 15 and you have active income. Although you think about child actors, you think about child models, they're already making money. There's no age really, but it's easy to get a job doing things like working at Chick-fil-A or something only after 15, I believe, or 16. But really, there's no age. If you are 5 years old and your parents have a business, they could employ you. If you're a child actor, you could be employed at any age. Which is better, IRA or Roth? So IRA can be Roth IRA. So those are not comparisons. So a Roth can be an IRA, a 401k. Similarly, you can have a traditional IRA or 401k. Which is better, traditional or Roth? Depends. Generally, if you can pay less taxes upfront in Roth, it's better. But if you're paying a lot of taxes upfront, a Roth might not be super helpful. If your tax bracket is high, very high, then Roth might not be so useful. Then traditional might be useful. If your tax bracket is really low, maybe Roth is the way to go because you pay very less taxes now, but you might pay more taxes later. What's the best thing to do? Like, what should someone do to earn a lot of money? Work hard, invest in the right places, figure out how to work not only hard, but smart, right? That's very important. Can you have both traditional and Roth at the same time? Yes, you can. Is 401k better or an IRA? So if you look at 401k or an IRA, one of the things you'll see here is the 401k has a lot more contribution limit. So let's look at, I'm trying to move this, but not able to. Okay, let's look at the contribution limits of 401k versus IRA again. So you can only contribute $6,500 towards an IRA. So it's very, very low, but you can contribute a lot more towards your 401k, especially if you're self-employed or have a business, you can contribute even more. So that's really, you always want to really have a 401k. You can also have an IRA. It's not one or the other. Is it advisable to start planning for retirement at an early stage? Absolutely. Like I mentioned, the power of compounding is in your favor and the time is in your favor. So you want to start contributing as soon as possible. What does it mean when it says qualified expenses? Qualified expenses are, these are qualified expenses. You don't have to pay taxes when you have a down payment for your first home. You have education. Let's say you're going to college, you want to get a degree, you can take it out of your Roth IRA. You have unreimbursed medical expenses you can take up. These are qualified expenses. How do you know when to invest? When you have money, you want to invest. Okay, I think 401k or IRA question has been answered. Any other questions? Are you guys ready for the quiz? So pay attention to the pre and post. Everybody understand pre versus post tax dollars? Pre means you haven't paid taxes yet. Post means that you have paid taxes. Tax deferred really means you'll pay taxes later, but for now you don't pay taxes. It's been deferred. Deferred means later. Tax-free means you don't pay taxes. Okay. Tax is paid at distribution. No taxes paid at distribution for Roth. All right. Any other questions? Please ask questions. All right. If there are no other questions, we will go ahead. You guys understand the concept of matching, right? Your employer will match your 401k dollars either at 50%, 100%, or somewhere in between. So we talked about the power of compounding with different kinds of accounts, taxable, tax deferred, tax-free. Which one is better? Obviously tax-free if you can make it happen. Next week or this week on Thursday, we'll talk about how to decode a paycheck. I know the retirement topic was a little difficult for a lot of people with this pre-tax, post-tax, but I hope you understood something. If you take away one thing from this session, it is understand the power of compounding, of saving early and investing often. Don't worry too much about pre-tax, post-tax. If it's confusing to you right now, it will become clearer as you invest and as you grow up a little bit more. So thank you all for joining today and have a wonderful evening. I will see you on Thursday at 4 p.m. Central. Hi, I'm Kavita Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.